What is the definition of infinite banking? And then I know you guys have said that there's 5 common myths, and I would love for you to kind of lay those out.
Usually, the messages that we're getting from mortgage companies, from banking institutions, from the general investment advice is put your money with this company, then everything is going to go well for you. And they're usually more in control of your money. Instead, you want to recognize there's the bank and there's the customer of the bank. Instead of just being the customer of the bank who is giving up cash flow, giving up the ability to earn interest, giving up the capital, we want to think about how can we insert ourselves into the position of being the bank, which means how do we get as much capital as possible? How do we hold it as long as possible? How do we earn as much interest on that money as possible? How do we give up as little cash as possible? How do we take as little of risk? How do we earn arbitrage or use leverage to make more money with that money? So infinite banking. So here is in a nutshell, infinite banking is a strategy of using a particular product, but it's most a strategy. It's a strategy of using specially designed whole life insurance that's dividend paying with a mutual company, and it's a high cash value product. So I guess I could say that a little differently, but it's mostly a strategy. It's a strategy of storing capital in a place that you're getting the most safety, the most liquidity, and the most growth. So it's growing, it's not going to lose value, and I can use it. I can access this capital. And it's a strategy of storing cash and then being able to use it at the same time. So I'm earning returns in 2 places at the same time, meaning that I am growing money and moving towards time and money freedom even faster.
Yeah, and the thing that I'm sure listeners are going to say, now, wait a minute, that doesn't work like that, and that's too good to be true.
What's the catch?
Well, I'll just tell you, I'm sure you have some of your laundromat owners that own their buildings where their laundromats are.
We do.
If they went to the bank, they're going to say, hey, can I borrow against my equipment, or can I borrow against my commercial building? And they would, and if they have enough equity in it, and if there's enough cash, they're going to say, sure. And in that case, then they take the money and they can go buy another laundromat. Well, now the commercial building and the business is still going up in value, hopefully, and they're earning money over here. Now, the difference that specially designed whole life insurance contract is that it cannot go down in value. The commercial building can go down in value. Okay, so that's one of the reasons that people would consider doing it with a specially designed whole life insurance contract. And this is actually one of the myths, that it's an awful investment. Well, that's because we don't consider this an investment because it has guarantees. We agree. If you're calling it an investment has risk. Okay, every investment has risk. This is not an investment. That's one of the myths. So it's not too good to be true, because you're not actually borrowing your money. You're borrowing from the cash reserves of the insurance company. So the insurance company has cash reserves. And because you have your money at their institution, they're going to allow you to use that as collateral. What's that sound like? What I just said with the commercial real estate. The commercial real estate has a mortgage at the bank. Oh, we have the collateral already established. We'll let you borrow against in a home equity line of credit, or in this case, it'd be a business line of credit against your collateral. It's not magic. I tell people this all the time. There are people that are trying to dispel this with myths. What is their motive of dispelling it with myth? Well, that's because they don't want people to put money in a place that traditionally returns 3 to 5% tax free. And when you do the tax equivalent, that's a pretty good return with little to no risk. So what is their motive? Well, they don't want you to put the money in the cash value life insurance. They want you to put it into an investment. So they poo-poo that situation.
And you know what? I think there's actually way more than 5 myths as well. Can I take the next one?
Sure. Go ahead.
So I'm going to say that whole life insurance is too expensive. I think that's a big challenge. And we see this come from some people who are very loud in the financial space and talking about
entertainment space.
I was like, is that negative to say? Probably. The financial entertainment space, yes. That many people know household names who would say whole life insurance is terrible. It's a scam. We've heard it's terrible and you should never put money in. And especially because it's too expensive. Well, then Bruce's famous question, compared to what? Well, normally, if you think of just insurance, life insurance, as I'm ensuring my ability to have a death benefit payout to my family if I pass away. Well, the cheapest form of that insurance that's going to do that job is going to be term insurance. However, term insurance and whole life insurance are two completely different products. Term insurance, generally, it has a time limit attached to it. So 10, 20, 30 years, those are some average ones. There's other timeframes as well. But during that time frame, if you pass away, the death benefit pays out. It's just simply that. It's death insurance. It pays if you die. Nothing available during your lifetime to access and use. So whole life insurance, if you think of it just from the insurance side as insurance, well, yes, it also has a death benefit, and you are going to pay a lot more in premium for that amount of death benefit. However, there's all these living benefits. And what I mean by that is that you can't compare it. It's not apples to apples in any way. It's a completely different type of tool. We really think of it as a place to store cash. So it is a place where you can put your dollars in. You're growing a death benefit that absolutely will pay out whenever you die, even if you live to 121. The contract goes up to 121. At that point, it will pay out fully the death benefit to you if you're still living. I say if you defy all odds of human life expectancy in this time frame of our lives. So not only will it guarantee to pay out, in addition, you have access to use the capital, kind of like equity along the way. So if the death benefit was the home value, the cash value is a portion of the death benefit, kind of like equity in your house, that you can borrow against and you can use, which means I can access this capital for anything, for an emergency, for an opportunity, for an investment.
Rachel, wouldn't it be much more liquid though than equity in a building? Like we have refinanced a property and it's like a giant pain in the butt.
Yes.
Only go up to 80% or all these, sometimes depending on their risk tolerance, only up to 70% on a commercial property and all these different things. Like, I don't know if I'm not the expert you guys are, but I mean, if that's my money, I just
you just withdraw it,
like
kind of like a bank account.
You simply sign a piece of paper. It says you want to borrow against your collateral. That's all you do.
It's a guaranteed access to your capital.
And I guess if I put myself in their situation in the life insurance companies, it's like they're the both sides, right? Is that am I looking at that the right way?
Absolutely.
Okay.
Absolutely.
All right.
And if something happened and you didn't repay the money you went out that you took out, then that's just less death benefits you would get.
So their risk,
absolutely.
So their risk for doing this transaction is really low.
Very low.
Absolutely.
Very low.
We talked about the 5 myths, and I think we only hit 2 of them.
We did.
We got derailed.
That's okay.
One of them was that it was too expensive. The first one.
That's a bad investment.
Bad investment. What are the other 3? What else do we need to cover there?
One we some of them are intertwined. Like one of them say it's a scam because you're just borrowing your own money. Why would you want to do that? And we already addressed that. You're not borrowing your own money. You're using your money as collateral to borrow against. That would be like saying, a home equity line of credit is a scam because you're borrowing your own equity because you've already put the money. You've already paid off your mortgage. So that's a scam. Well, that's not what you're doing. You're borrowing against the equity. Another one is cash value. It's bad because cash value takes a long time to grow. That's not true. That's why they're specially designed. Nelson Nash, actually, this was always a contract, and there's pros and cons. Sometimes you don't want have a whole lot of cash value early because you want something else. And that something else is more guaranteed death benefit. But if you want more cash value early, then you pull down the death benefit to get more cash value early in the contract.
So you're saying within these contracts, you can, I don't know if manipulate's the right word, but
pull levers, different levers. Hey, Dave, this
you
is
can
what
adjust,
this is what I tell people all the time is it's an actuarial product. Mm-hmm. So if you want more cash value, you're going to give up some death benefit. If you want more guarantees, then you're going to actually get more dividends. If you don't want as many guarantees because you don't want to have to you don't want to have to be obligated to put more premium in every year, well, then you can actually design it like that too. But then you're going to get less dividends. Mm-hmm. I tell people it's a mathematical product. Mm-hmm. If you want more over here, you're going to get less over here. If you want more over here, you're going to get less over here. It's not magic. And then the final thing is one of my biggest passions is people say, well, I can prove to you it's a scam because you have the cash value and then you die. They only give you the death benefit. They keep your money. They keep your cash value. So let me use this example. Let's say you have $500,000 of cash value that you built up over the years through premiums, through guaranteed interest, through dividends, and you have a $2 million death benefit. You have a $2 million death benefit. So when you die, yes, the insurance company sends you your beneficiaries a check for $2 million, and the cash value stays with the insurance company. So people say, see, I told you. See how it's a scam. They're keeping your $500,000 and they're only giving you the $2 million. Well, that's because they don't understand actuarially how it works. The insurance company is only charging you the difference for their risk. So they know they are going to get to keep the $500,000. They're not charging you for $2 million of life insurance. They're only charging you for $1.5 million of life insurance. But these entertainers don't understand how the math works. It would be similar to say, hey, I have a mortgage on my home. I've paid it down. It was a $1 million mortgage. Now I have $500,000 of equity. Well, wait a minute. When I sell my home, I want the $1 million and I want my $500,000 of equity.
Yeah.
Well, that's absurd. And everybody knows that's absurd. Well, it's absurd because it works the same way over here too. So basically those are the 5 myths. They're kind of over. And like Rachel said, we can give you a bunch more, but those are the 5 things that come up over and over and over. This concept's been around for 200 plus years. It's probably legit because there's been a lot of eyeballs on this for 200 plus years, and it's sustained this over 200 plus years. So I don't think you have to worry about it being a scam. It can be a bad strategy for some people.
Why? But when would it be a bad strategy?
Well, it would be a bad strategy if I came into your home and you're a 24-year-old and you don't have enough cash flow and you work for, let's say you work for the restaurant industry. And so your income is not guaranteed because restaurants go out of business all the time. And so now you get together and you put a policy in place and there's some contractual. Now there is some flexibility, but there's some contractual obligation to continue to make your premium. So then I would say, hey, you probably should start with some term. We can start putting some money in here, but let's do it at a lower amount until you build up some assets. And then we can actually transfer those assets from the bank into your own personal contract, which we would say to the bank. But other than that, because you can borrow against the policy, there's not a whole lot of downside. If you think keeping your money in a bank is a good thing, then there's no reason why you wouldn't keep money in a whole life insurance contract. Because all we're trying to do is have an alternative place to store cash.
So this I'll add kind of as a last bonus, a side bonus myth here is that if you're looking for a get-rich-quick scheme, I guess the myth would be there are get-rich-quick schemes. This is not a get-rich-quick scheme. I can't even say that quickly. This is absolutely a build wealth over time plan. This is a person having a long-range focus, not just thinking about tomorrow or next week or 2 minutes from now. They're really thinking about, how do I create something that's going to benefit me in my later years, when I will value life insurance a lot more, when I will probably be thinking about my children and what I can do for them more, and when I'm in a position of saying, wow, I really wish I had made better decisions. So the challenge is that a lot of times there can be this thinking that, well, I just need to go try to get as high of returns as possible, which means I need to take a lot of risk, and I should just go ahead and do that because no one wants slow, boring returns, and saving money is worthless. Like, that can be a challenge where somebody says, there's no point in saving money. I just need higher returns so that I can build up a bigger net worth and I can have more money to live off of income in the future. So the truth is that it is very important to be saving, and it's not boring to be saving. And a person who has good money habits and is consistently putting money into savings has such an advantage. That is a cornerstone of building wealth. It is a habit of true wealth creation. This habit of always paying yourself first, always focusing on profit first before expenses, and being in a position of saving. When you do that, then you have the ability to have growth with uninterrupted compounding, which is tremendously powerful. And when you do that, you don't need to just be chasing that get rich quick scheme, that super high return, that super high risky thing that seems like the only answer in today's economy with low interest rates. No, instead, having sound money habits, saving first, and then thinking about how you can use your savings, use your store of capital to borrow against it and put those dollars to work somewhere else. That makes all the difference in the world.